Good morning and welcome to MarketCast 10. Who'd have thought we'd have hit it? I'm delighted to be broadcasting this morning from a very sunny Bournemouth. It's one of those beautiful, really early spring mornings, crisp and cold, little bit of frost on the car, as some of the team here will tell you. But the blue skies, and from where I'm standing, I can actually see off there to the west the Purbeck Hills and even a little bit of the sea too. So it's a fabulous morning. It's a fascinating thing. When we did MarketCast 9, I talked about us being on a knife edge, wondering which way this market was actually going to move. Well, I think that knife has actually flipped onto its side. And not only do I believe that, I think that you're starting to see this theme being picked up in mainstream media too. We'll come on to a little bit more of that later on. But in the meantime, I just want to talk a little bit about the reason I put the way I put my projections together and the reasons that I come up with the forecast that I do. I love this slide. We actually put this slide on when we did MarketCast 9. And it's this wonderful diagram here of left and right brain, of the scientist and of the creative. And that's how you formulate a forecast, because it is impossible to sit down and use ChatGPT or any other automatic intelligence because it's the future. It hasn't happened yet. So you can only base it on the intelligence you've got and the knowledge that you have, and then it's a little bit of gut feel mixed in too. And here's the thing, not that I am trying to persuade you to go back and lose another half an hour of your life, but if you wanted to dip back in to MarketCast 8, back in November, when the world was looking like a bit of a desperate place, I think I was probably the only lone voice at that time saying that the market was going to be okay as we came into the new year, and the sort of levels that we would be experiencing were going to be those that we did in the years running up to COVID, those classic years from 2014 to 2019. And of course, that is exactly what we have. And I want to just explore why things have actually panned out that way, why the last quarter of 2022 was so dreadful, why things seem to be calming down, and as we move into what I'm going to characterize as a challenging market rather than an impossible market. Some of the press work on this was, well, frankly, ridiculous, wasn't it? And, we had this sort of stuff going on. The Guardian coming out was saying the prices could fall 20%. Do you know what? That in all my working history, in the 40 years that I've been doing this stuff, the very worst patch I can find is that 2008 to 2009, and the market only fell by 18% during the meltdown of the entire financial infrastructure. And here's the Guardian publishing stuff saying could fall by as much as 20%. I've got to say, last night, I was putting this deck together last night, and I did try and find one or two of the 30%ers. I know they're out there somewhere, but I ran out of time, to be honest with you. And I thought I'd focus on more constructive things to stick in this deck. Here's the Harry Hill. That's not the comedian, although when you read this, you could be forgiven. You could be forgiven for thinking. This is Harry Hill that ran Countrywide for all those years and was one of the founding fathers of Rightmove and so on. And he's suggesting that house prices were going to fall by a fifth. So all of this is in the last quarter of last year. Here's Paul Smith here saying, brace yourself for 2023. Here we go. Volumes are going to fall by 37%. Which means that we would have seen around 800,000 transactions in 2023. Well done, Paul. Best of luck with that. Here's the Telegraph, and they're publishing their story. It's a price nosedive. I love the word nosedive. They were all out there, weren't they? They were all out there. And yet there were one or two siren voices. I managed to find this. Here's David Hanna. He's come out, and this was during this time when we were really looking into the abyss. And he's talking about a market that's set for growth of 8%. Well, even me, in my most optimistic guys, wouldn't project growth of 8%. But David Hanna, who does know what he's talking about, did. And just to encapsulate all that, I loved this story. And this is just picking all that up and all of that doom and all of that gloom and all of that conviction that the market was really going to fall on its face because of the issues that we were facing during the last quarter, and they were tough. And we saw new build reservation rates, average reservations per site per week dropping below 0.3. So it was really difficult. So here's Martin Lewis during his TV show talking about the market and where it might go, and he decided to poll his viewers, his ITV viewers on Twitter, and 44,000 people responded to this. Now, bear in mind, they have been hit with a barrage of media comment about how bad the market is and where it's going to go. And almost a third of these 44,000 people still expected house prices to rise over the next 12 months. The beauty of this is that they might not be experts, they might not be sitting in a room surrounded by economists, they might not be dealing in the market all day and every day, but guess what? They are the actual market. And of course, how consumers and home buyers feel about the way the market's going to move directly affects how the market performs. Just over a quarter thought that prices might fall. So almost 3/4 thought they would either go up or stay the same. That's a fascinating insight, isn't it? A fascinating insight into how differently the UK home-owning public were seeing things as against the commentators and some of the media. So we've got to explore this a little bit before we go on, because I think it's important to establish the credibility of this forecast. I'm going to tell you what I think the market's going to do, but the credibility is everything, because obviously, particularly with the new build audience of this market cast, big decisions are made on how you feel the market is actually going to play out. So why the confusion? It all started here. And to be fair, I have got to take some of the guilt for this myself, because I remember saying in a market cast back August of last year, working out volumes 3 months ahead is really easy, because all you do is you just take the number of mortgage approvals, you stick another half on top. So if there are 60,000 mortgage approvals in a month, it's going to be 90,000 completions in 3 months' time. And that's a really easy way to work out how volumes are going to go. Unfortunately, when you make statements like that, which sound so really straightforward and obvious to me, things turn around and kick you in the teeth, and sometimes they don't work like that. Regular viewers of this market cast will know, however, that when I put my matrix together, which determines how I feel that prices are going to move, one of the real nasty subjects on there, one of the real nasty factors on there, I should say, is mortgage availability. It's the one thing. If you take mortgages away, it just means that people can't buy no matter what. And of course, what actually happened is that after the mini budget in September, the Truss Kwarteng magnum opus in September, half of the available mortgages were literally wiped from the market. Not only that, live offers that were actually out there were withdrawn as well. So suddenly all of those people that were still going to buy, and the market was already in transition, gentle transition downward, but there was a whole bunch of people out there waiting to buy, suddenly couldn't get a mortgage. Well, what do you think is going to happen? If in September you take half of the mortgage products away, this is what happens. So if you look at the numbers here, so these are the latest numbers that we've actually got here, and this shows the numbers as at the end of December, and you can see house purchase mortgage approvals dropped to 35,000, really low. And of course that sent everybody into apoplexy. Oh, the market's going to crash, a third off, 37% off volumes. But that's not a true reflection of how the market was, because here's the thing. If you take mortgages away, it means that you take away the person's ability to buy. But what you don't take away is their need or their desire to buy. That's still there. And what they're actually going to do is they're going to wait until the mortgages are available, and that then creates this pulse in the market. And that's what we've had. And that's why this whole thing has actually seemed so confusing, because what's really going on, and the real secret behind the way this market is moving, has been a transition from what I call a wants-based or a desire-based market into a needs-based market. And that is a fundamental aspect of why this market is performing the way it is, and why we've seen what appears to be a bit of a recovery in January, and why I am still convinced, and going to stick to my guns, that we're going to see a slight price uptick as we go February into March into April, before we start to see an easing of those prices. And the reason I think we're going to see an uptick before we see a gentle softening of prices through the year is because we've got that bubble. So we've got all of those people, the needs-based people, I'll talk more about needs-based people in a minute, those needs-based people that couldn't buy in Q4 2022 are buying now. Because now, okay, mortgage rates have gone up, and they're going to have to be buying between 4 and 5% probably, that sort of mortgage rate, but they can manage that, and they need to move. So it's going to happen. This, for all the marketers looking at this, is a really big and important thing. We need to consider that when we talk about the propositions that we're setting in front of prospective buyers. For a bit of fun, I found this on the internet. This was produced by a company called Harrody's. They're a London-based removals company. I have no idea what the sample size was. I have no idea how they carried this research out, so I cannot vouch for the credentials of it. But it was a perfect way for me to demonstrate exactly what it is that I'm talking about now. This was their top 10 reasons for people moving in a survey that I'm guessing that they carried out with their database or their customers. And that seemed to me very reasonable. It doesn't matter. The bona fides of this is less important. It's the point that I'm making that's important. Look, so here are some of the reasons here. Number one reason, need more space. Number two, I want to upgrade. Job relocation. We're now empty nesters. Relationships, that's the old classic divorce, death and so on in there. Visiting family, school catchment areas. You can see them. So what I've done is I've put down here my view. So this isn't Harrody's, this is me. I'll put down my view of whether that is a wants-based or a needs-based decision. So I need more space. Well, it's sort of pretty much indicative. Jobs, the meaning's in the title there, isn't it? Needs-based, wants-based, needs-based. My point is this. When we're in a really red-hot market and we have rates rock bottom, then people are saying, do you know what? Why don't we upgrade? We can get a fortune for our place and we can do this and we can... So that is very much a desire-driven, it's a wants-based decision. When the rates go up and things get a bit tighter and you're not going to make that full asking price, then you think, do you know, I'll tell you what, we'll leave that for a while. But the needs-based market is still there, because if you need space when interest rates are 2%, you still need space even though they're 5%. And so although that modifies your decision, or at least it suppresses it slightly, that market is still there. And that is what we're seeing coming through. That is why we've got the pulse, because that market was artificially suppressed in Q4 2022. And that those people, those needs-based people, are coming to the market now in Q1 2023 as mortgage product is becoming more available. And of course, the institutions now are getting competitive. They need the business. So where all of that up and down, where did it leave the indicators? Rightmove came out with a no movement at all in asking prices. And here's the thing. So I've positioned these, I've stuck 3 indices in this time. I've taken loads of charts out. I've taken all the RICS charts out because I don't want to depress you on a Tuesday morning before you get into the meat of the day. But what I have done is I've left in the asking price index, Rightmove. I've stuck Zoopla in next, mix of asking price and achieved prices and mortgage approval prices. And then I've also stuck the Halifax in at the end because that's based on mortgage approvals. I was speaking to a room full of about 220 people a little while ago, and I said, okay, I'd like to ask you all, if you were going to sell your house tomorrow, would you put it on the market for the price you want? And I promise you, not a single hand went up, because we don't, do we? Your asking price is the opening proposition in a negotiation. That's the way it works. And we have seen this crazy market in 2021 and early 2022, where prices were being achieved above asking price. But as that's transitioned and we come back much more to reality, we move back into a much more normal market. And that means you put your house on the market for a little bit more than you want to afford, because you know you're going to get a bit of a chip. That's the truth of it. And if we're honest with ourselves, we know that to be the case. This is brand new this morning. This is Richard O'Donnell at Zoopla, waiting to the day of the MarketCast before he publishes his February figures. But I picked them up first thing this morning, and they're always brilliant numbers. And you can see, this is Zoopla with their unique blend of asking and achieved prices and so on. And they've got annual inflation still at plus 5.3%. But they put some really interesting data in this month, and showing the discount to asking prices. I picked up their little chart showing how that's progressed over the last 5 years. But it means that if people are discounting their asking prices by about 4.5% right now, it means that they are discounting the price by about 14 grand, which means they're losing about a third of all the gains they made during lockdown. That's not too bad, is it? I call this sellers getting real. And they Zoopla show this morning on their new numbers, February numbers, the discounts that people have been giving off asking price. And you can see even in the crazy 2021, 2022 market, the asking prices actually were still being reduced, albeit very, very slightly. And here we are, little bit of a pendulum swinging effect here. Lots of people flying kites. Do you remember I did the whole flying kite thing? And so lots of people realizing that they went crazy with their asking prices. And that needs-based market, who have got to move, are coming back to the real world and realizing that their asking prices need to get real too. And then the whole market just calms down a bit. Halifax, well, their monthly change was 0 as well, so a little bit like Rightmove, and they've got their annual change now almost flat at just under 2%. And that's on mortgage approvals, of course. And it means that where these huge rises have been slowing down, that the price to earnings ratio is coming down. And I'm starting to learn, because when I say starting to learn, I really do mean that, because the interest rates that we've seen over the last 10 years are unique, or certainly in my lifetime, at 0 or 0.25, and mortgage rates at under 2% were a unique thing. And that's obviously driven prices up. So it drove this enormous price to earnings ratio up way beyond its long run average of about 4.5 times. And we can see as interest rates go up, you can see then how that price to earnings ratio comes down to meet it. And that is just the force of economics. You can't get away from that. But the importance of interest rates and where they're going cannot be overstated. This is how the chart looks. I don't even really need to dwell on this too much, do I? So this is where we went. Here's September. Oh my days, you can see where it went. And then reality came back, and you can see now pretty much across all loan to values and all fixed rate periods, you can see now it's starting to come back to normal. And of course, that means that confidence is starting to come back. And these are the Bank of England numbers here that at the end of January, these numbers, and you can see these are all now in the 5s, late 4s, and early 5s, depending on the loan to value. Inflation went crazy, didn't it? Look at this. That was the war in Ukraine and fuel prices and food prices and everything else. But that's coming back as well. And I've got the numbers on here. You can see that my favorite indicator on there is the CPIH. So that's the CPI with the homeowner costs in as well. So for us and our target audience as developers and the way it affects the housing market, that is the most important indicator for us. And you can see the CPIH as at the end of January, came under 9%, and it's on its way down. So that's coming down and coming back to normality too. And so what effect does this have? And I'm not going to spend a week on the consumer confidence barometer because I've been told off for doing that recently in one or two meetings. I could spend ages talking about this, as you well know if you're a regular viewer. But this red line through the middle of this, or used to be in the middle of this chart, all the time it's been in negative for the last God knows how many years. The red line's actually stuck at the top there, but that's zero. Things below that line actually mean that confidence is in the negative. One of my team here, by the way, has just held up a chart saying, get a move on. So, a sign rather, say get a move on. So, but you can see it's important because we've got this uptick in consumer confidence and people are getting a sense, so I'm not going to spend ages talking about this, but people are getting a sense that things have calmed down. They are still difficult, they are still going to be challenging, but at least we are not on that slalom ride downhill. This was out of this morning's Zoopla, and I thought this was a smashing thing that they've done here. So what they've said is, here's demand. And I think, if you don't mind me being presumptuous here, Zoopla, but I think they've learned a lesson from some of their previous headline numbers where the press have picked up. So here's demand at minus 51% compared to this time last year. Now you can imagine the headlines out there. Oh my word, it's Armageddon. But when you compare them to pre-COVID, those numbers, so these are the 4 weeks up until literally last week, we're actually 8% up. So in a normal market, demand for this time of the year, it's 8% higher than it was. Whereas if we compare it year on year, this year is against the last crazy year, well, you can see it's 51% below. And that often gives rise to these crazy headlines. So that's a really good chart, Zoopla. Well done. And you can see flow of new supply. Okay, compared to against this time last year, it's a little bit better. Pre-COVID years, just a little bit worse. Sales agreed look dreadful, don't they? At 24% down against last year. Last year was crazy, as was the year before. Compare it to the 5 years pre-COVID, and it's just almost identical. And finally, the stock that we've actually got available for sale, well, against this time last year, when there was nothing you could buy, nothing, you had to have an estate agent who was your best friend to have any chance of buying anything. We've got 61% more stock now than we had this time last year. And you can see, though, that still compared to pre-COVID, it's 11% down, so there's still that slight stock issues. I wanted to shove this in here. This was last October. This was my market factor matrix from last October. And you can see here, mortgage availability, brutal, high impact, highly negative. It was massive. And I fetched that out to compare it with today's. And if you look at today's, mortgage availability is here. Because all the lenders, all the institutions now are saying, we want to lend you some money. And I tell you what, we'll make it as competitive as we possibly can to be able to do that. So that's moved right back here. High mortgage rates still feature, but even that has moved backwards. Low affordability is up there, and that is particularly with deposit affordability too. The big positive effects here are the ones that the developers could do most about. Part exchange coming into its own right now. Golden time for part exchange. Financial products, Help to Buy has to be replaced. And discounting, of course, or reducing of asking prices, let's call it that. So, change in demand patterns. This isn't from this morning's Zoopla, this is from last month's. But I thought it was worth keeping in because what it does do, when you get the chance, take a closer look at that. I won't dwell on it now, but it shows the shift in move back to apartments as people are starting to go back to work. Agent stock, these are the Rightmove numbers that from their February report, which shows the agent stock in December. And you can see that started a little bit of a decline. I think that we're going to see that coming back up the other side. So let's importantly spend our last few minutes talking about what's coming, because that's what really matters. And first of all, let's look at volumes. there's a lot been said. I've already said a lot about volumes and about mortgage approvals, but if you look at the numbers, so this is the actuality. These are numbers produced by HMRC based on stamp duty payments. So they're pretty accurate. And you can see the red line on this chart here. This is a chart that just shows from 2020 up to 2023. So 3 years worth on this chart. And the red line there is seasonally adjusted. We know all about those spikes, the lockdown spikes. We know all about those. So let's just ignore those for the moment. Look at this line here. This is absolutely, so here, this is March 2020, the very first lockdown. And here's the spike coming out of it, and then the second lockdown and so on. But if you take that line across there, we are reverting back to the market how it was before. This is this needs-based market, how it was before, and there is no doubt in my mind that's the way this year is actually going to roll out. You know, I'm thinking about that story that I stuck up on an earlier slide saying that they're going to see volumes around 800,000. No, we won't. No, we won't. You know, the volumes will be between 1 million and 1.1 million, and of that I'm convinced. And you know, and I take that as well, looking at all the data that I see coming in from our client developers too, and the way that we're changing our efforts to grab additional market share. I am convinced that's where we're going to end up the year. My new best friends, 20 CI and 20 EA, who have given me some access to some fabulous data. I've not really got my head around it yet. I've not had the chance, but I did love this little snapshot, which shows us that where the property market sat at the end of February. And you can see there, it's really fascinating. 529,000 properties currently on the UK market, and of those 352,000 are sold subject to contract. And you can see how that varies through the regional markets. That's a really interesting chart to go and take a look at. And the beauty with their data, the EA side of it data, is that you can drill that down and look at it by postcode. I'm going to get into that database, but that's going to need a little bit more time, perhaps not on a MarketCast week. So where are prices going to go next? Well, I'm sort of a bit of an outlier here, because this is how I forecast the nationwide index is going to run. And don't forget, of course, the February nationwide numbers are probably going to come out today. So by the end of today, you'll be able to look at their press release and say, well, you got that wrong, or right, possibly. But I'm seeing that the nationwide numbers for today will probably move into a very slight negative, you know, and it really will be very slight, could be less than 1% even. But so we'll go from 1.1, which is an actual, down to just under 0. And we'll stay in that negative growth, I think, through the year, but very gentle negative growth. It will end the year still only around -4%. But if we do, bearing in mind that that inflation number is based on the previous 12 months, and if you look back at where we were 12 months ago, that means that prices in March will actually uptick. So we will see that March uptick. And don't forget what I was saying about the pulse from purchasers that couldn't buy in Q4 2022. That's where I see that prices are going to go. And I hope you don't mind me sticking that little still in up there, because I think I'm pretty much on my own there. But I'm staying with that forecast. Don't forget the new homes premium. So important. Starting, you'll just see a little, it's just starting to close. I said that gap will close. These are the very latest numbers that Land Registry have. These are to the end of October. And I checked last night. These are the latest numbers you can get. It's closing. And I've said that gap will close, and I am absolutely certain that gap will close. And I think that when we see what we've got in January, February, which will be a few months yet, we'll see that that has already happened. And I'm sure for the developers watching this, you'll know that already. So in summary then, the mortgage hiatus, that whole mini budget nonsense, that is what has actually completely distorted people's view of the market. And I've been sent by some clients comments from their analysts. You know, these are high-powered financial institutions. The analysts saying it's going to be a disaster, 2023. It's the volumes and prices, and they have massively misread what has gone on at the end of 2022 in my, I was going to say humble opinion, but it's not really very humble, is it? In my opinion. So we've moved, we've transitioned. We had our desires based, we had our wants based market that drove those huge increases in selling prices, and that's come into a needs based market. The people that are buying right now are the people that need to buy, you know, unless you're talking mortgage free people, of course. So there is still an element of that wants based is out there, but the core, our core market is that needs based market, certainly for the developers in my view. It seems now that pretty much through, look at the press right now, look at the commentators right now, I think that knife has fallen over. We were on a knife edge before. I think we've come the other side of it. I think the general consensus is that we are going to see a soft landing. I think that comes right the way through. Still thinking there's going to be a price rise in the spring. I am absolutely certain that new homes values or asking prices are going to have to come down a bit quicker than second-hand asking prices. And I still say that 2023 is going to show inflation, or negative inflation of around 4%, and transaction levels between 1 and 1.1 million, and new homes share of that market at about 12.5%. I think that is everything. Look at that, bang on time. I think that's our first time ever. Because I took a whole load of charts out, but you'll be able to look at the data in here in a lot more detail. And don't forget, all of that other data that I normally include, the RICS stuff and the detailed charts on Rightmove and so on, are all available online. But that's how I see the market. So right now it is challenging, step up to the plate, get creative, get the IFAs involved, be commercially realistic with asking prices right now. And finally, because I didn't touch on it all the way through this presentation, recognize the difference in local markets and regional markets. You know, even today's Zoopla numbers actually went from 7-point-something%, Nottingham still leading the way, down to 0.2%. Aberdeen have come into positive growth at last. So it's not now 10% between top and bottom, but it's still over 7%. So that's a huge amount of potential margin to be won and lost. So we need to be aware of local markets. Next MarketCast could be a really big one, because there's going to be lots of stuff now that actually shape us up and point us in the right direction for the spring and summer market. So join me, our biggest ever audience this morning, by the way. So I hope that I've kept you, and we'll see you again on Monday, the 27th of March. We'll send out a note, we'll put a note out on LinkedIn, and we'll email everybody with the opportunity to register. Thank you for your time this morning. Have a great day today. I hope the sun's shining where you are, and I'll see you in March.